This is the federal Mississippi tax consideration session. I'm going to introduce our speakers at this time. Bennett M. Jeansonne.
Close enough.
Okay. He goes by Benny, is a partner with Silas, Simmons, LLP of Natchez, Mississippi. He's a 1983 graduate of LSU with a Bachelor of Science in Accounting, was awarded the Accountant Advocate of the Year by the state of Mississippi, Small Business Administration in 1997, and is the 2014 recipient of the Mississippi Society of CPAs Public Service Award. Well, congratulations. And Peyton Cavin, CPA, is a 2005 graduate of Southwest Mississippi Community College and a 2007 graduate of Mississippi College. He joined the accounting firm of Silas, Simmons, LLP in May 2007. Mr. Johnson and Mr. Cavin will provide insight into the federal and Mississippi tax considerations royalty and mineral owners should be aware. I passed out some handouts. If you don't have one, please raise your hand and I'll bring you one on our way back down the aisle. All right, it's all yours.
Great. All right, thank you, Janice. We appreciate the opportunity to come over here and share a few insights or some of our knowledge with you guys. I would like to keep this as informal as possible. If you have a question, don't understand something that we're talking about, or you have a question of a particular item, just go ahead and raise your hand up. We'll try to answer the questions as we go along. If not, we'll save some time at the end to answer some questions. But just to kind of introduce ourselves, again, Peyton and I are both from Silas Simmons. We're a CPA firm in Natchez, Mississippi. Our firm's been around since 1932, so we've been around 82 years. We're on the Mississippi River. We work out of one office in downtown Natchez, Mississippi. We have about 45 staff at work for Silas Simmons, and so we cover just about every facet and every industry that you could possibly imagine. Some of our larger industries that we do concentrate on are financial institutions, oil and gas, and I'm going to say agriculture, but agriculture is more than just row crop. I'm talking about land and timber, and as well as row crop. Our practice is about 50% in Mississippi and 50% in Louisiana. We cover clients in Jeansonne, Louisiana, Alexandria, Baton Rouge, over here to Brookhaven and Macomb, up to Jackson. So we cover a large area. And as Janice mentioned, I graduated from LSU in 1983. I've been in Natchez for 30 years now. I've been with Silas Simmons 28 years. I had some personal family interests in the Tuscaloosa Marine Shell down in West Feliciana Parish, just south of the state line, as well as over around Pond, Mississippi, and Wilkinson County. Peyton, he's born and raised in Natchez and Woodville. He actually lives in Woodville currently. He too, his family's in that area, so we not only have clients in this area, we have a little family as well in all this area. Today, we got a few items. I don't know if any of y'all sat in the last program, but there will be some duplication, but I believe most of y'all are going to be the first timers in here, so we'll try to go through that as easy as we can. And Peyton's going to cover income taxes, the net investment income tax, the alternative minimum tax, severance tax, and then I'll go over gift and estate tax toward the end. But if you have any questions, if it's on your mind, go ahead and raise your hand, and we'll go ahead and try to answer your question. And you can ask us even if it's a question about something that we're not going over. Go ahead and give us your best shot. If we don't know the answer, we'll definitely figure it out and get back with you guys. So right now, I'll go ahead and let Peyton cover his section.
Y'all, I appreciate you coming out. I really want to thank Burnell McGee and some of the other ones who helped put all this together. I mean, they've done a really great job, and I appreciate everybody coming. I appreciate Benny for coming with me. This is kind of just a short list of taxes that you as mineral owners may be subject to. Income tax, net investment income tax, and some of the others. And we'll just kind of go through this list one at a time and just kind of basically just make awareness that you may potentially be subject to these taxes. kind of the first step in the process of getting into an oil and gas lease is the actual lease bonus that you received. And you know, from a tax standpoint, this is taxed as rental income to you. So it's subject to some limitations on passive loss limitations. If you have other passive losses, you know, you may be able to offset those and that kind of thing. It's also, you know, potentially subject to the net investment income tax, which if you set through some of the other sessions, you may be a little bit more familiar with. We'll get in that in a little more detail in a few minutes. You know, and many of you may have already received them in prior years. You know, you're familiar with the 1099 reporting rules and things of that nature that, you know, you're going to receive a 1099 for that tax as rental income. So we'll just kind of continue with that. Not much there other than it's just, you know, subject to ordinary income rates, which can range anywhere between from about 10% on the low end up to, you know, the upper ordinary income rate, 39.6% federal. Also, you know, if you're in Mississippi, you're looking at probably another 5% rate there. So, yeah, this is just kind of touch base on those passive activity rules I was referring to. You know, chances of you having a loss on a mineral lease are very slim. There's just generally no expenses against it. Maybe some attorney fees, legal fees, you know, tax preparation fees and that sort of thing. Usually not a very likelihood of actually having a loss there, but if you have other losses from passive activities, you may be able to utilize those losses utilize that income to offset those losses. Passive activity income, passive activity losses can only be offset by passive activity income. Any loss that is not allowed in a current year is then carried forward to a prior year. So, you know, some people may have passive investments in partnerships or other things that they're not participating in, may have accumulated some losses over the years. You know, there is some potential there to offset some of this income from leases with those losses. You know, just, you know, they can be carried forward indefinitely, and, you know, partnerships and S corporation income that you're not active in can contribute toward that. All right, just to kind of continue on that, you know, once the lease is obtained, the well's put in, goes in production, you know, you'll start to receive royalty payments. Very similar rules as what the rental is, with a few exceptions. It's going to still be reported to you at Form 1099 like the other. You're probably familiar with that. You know, again, you'll be able to deduct expenses against it. Severance taxes in Mississippi is usually a 6% rate. Is that a straight 6%? Yeah, straight 6% rage. You know, that's going to be held out of your royalty payments before you ever receive it. So you're only going to get about 94% of the of your share of the gross production. Severance tax is already being withheld. Now, you report the gross production and take percentage depletion on that and are able to deduct these expenses back out on your return. So it's being withheld out. You're able to go ahead and take a deduction for that as well. Again, if you've had any kind of legal fees associated with that production or any other kind of expenses, those are also deductible. This is not subject to the passive activity rules. So, you know, it can be offset by any other passive income, but you know, there are some other deductions allowed. One of those being the depletion allowance. This is really a big one in oil and gas. You have two options, the most common being percentage depletion. So just to kind of get into that, you know, what is depletion? Many of y'all are probably familiar, if you have businesses, you're self-employed, you know about depreciation, the tax allowance for depreciation on equipment and that sort of thing. Essentially, depletion is depreciation of the oil that is being extracted out of the ground. So as more is extracted, you know, there's less in the ground, you have less there available for you. That's your deduction for the actual oil in place. Two methods for that. Most commonly used is percentage depletion, which is based off of a percentage of gross production. And that percentage, normally in oil and gas, is 15%. There are some rules based on contracts and all. It can be a little higher, and also if oil gets under $20 a barrel, which I don't think is very likely, you get a little step up there too. And it'd just be straight 15% based on the gross. And the other option is going to be cost depletion. Now, cost depletion is not very commonly used by the actual mineral owner. It's based off of actual purchase price or inherited value of the minerals. So, for instance, if you were to go out and buy some minerals for X dollar amount per acre, you could then amortize that cost out over the production of the well. And the IRS allows us to take the higher of percentage depletion or cost depletion. Most people, minerals have been in the family for years. They've either been inherited, which we could have had a stepped up basis, probably were not valued very high at that time, or you have owned them for many years. So cost depletion in those situations is going to be a very small number. Percentage depletion is going to be your higher number. Just a general overview back on percentage depletion, you can kind of go through that. It's got some limits on it. Limited to 100% of taxable income from a particular well. If it can't, basically what that meaning is, it cannot put that well into a loss situation if you had other expenses for whatever reason. And also, it cannot offset 65% of your taxable income. So it can never take your tax to zero is essentially what that means. Any that's not used will be carried over to offset future income though. So the deduction doesn't actually go away. It just be carried over indefinitely until it's used, or other issues. Okay, then there's one other note on that. Mississippi does not allow percentage depletion. They do allow cost depletion. So you could get into a situation where you would want to use. Sorry about that, y'all. Where you want to use percentage depletion for federal income tax and maybe cost depletion for Mississippi. You have the option to do that if for some reason that'd be advantageous. Not very likely. All right. If you set through some of the other ones, especially through some of the investment ones and maybe through some of the attorneys and all, they may have covered this new net investment income tax. And this just came out starting in 2013. Part of the health care bill, formal language on that I guess is the Health Care and Education Reconciliation Act, imposed some new taxes on us for some higher income earners. A lot of people who are getting lease bonuses and things for the first year may be subject to this tax. At least in in a year they may have a lot of income. So just to kind of familiarize yourself with that, to know there's additional tax out there. It's a standard 3.8% of net investment income over a threshold, which is $200,000 for single, and which would also include head of household, and also $250,000 for married taxpayers. I don't have it on the slide, but if you do file separate, if you're married and file separate returns, that number is split, which would be I do have it on the slide, I'm sorry, which would be $125,000 apiece. So just keep that in mind. Now the way that'll be calculated is if you had, just say, a straight lease, you are a single taxpayer and you had a lease for $200,000 even, you wouldn't be subject to it, okay? If you turned around and then had wages in addition to that of $50,000, you'd be subject to the tax on $50,000. So just keep that in mind, that this tax is out there, and that for some higher income taxpayers, this may be an issue, and there are some ways that we can minimize that tax. Potential ways to reduce that tax. If you have multiple parcels of minerals, multiple tracts, or maybe in multiple sections, one thing you can do is to help minimize that tax is to try to spread that income out over multiple tax years. And one way to do that is just to lease the payment, to lease the minerals in multiple years, so that you receive the payments and the income is spread out over those years. Another thing you can do is, if you have other wages or you're self-employed, have other income, may be able to utilize some retirement plans to help defer that out, lower your adjusted gross income, and also lower that tax. if you're selling any kind of real estate or anything, you know, maybe installment sale might be an issue, might be something you could do. You could, and what installment sale essentially does is it's recognized. Installment sale is basically like you sell or finance a property or whatever it is you may be selling, and that income is recognized as the payments are received. So it'd be spread out over the life of the loan. And you know, if you had a closely held corporation or something like that, you could time some dividends to help reduce that tax. Defer them off into an earlier year, take them earlier maybe. All right. You know, one thing I think that probably is getting overlooked some by just in sheer tax planning is, you know, is damages and easements and all that you may have on your property. So if you're a surface owner and they're crossing your property, they're setting up a well site on your property, you are likely to receive income for that, you know, based on damages or based on their right-of-way on the property. So just to run down the list, you know, if they're paying you for loss of business use of your property, for instance, you had a farm, you're running cattle on it, you know, and they pay you pay you a settlement amount based on that, that's going to be taxed as ordinary business income. It's going to stay as the income that it's replacing. You know, if they are paying you for damage to the property that they occurred after the fact, it would be a reduction of basis in the property and would only be taxable if the basis in the property went to zero and you continued to receive payments. So just to give you an example of that, you had a piece of property you paid $100,000 for. They come in, you know, do whatever they do, put a well site on the land, they pay you $120,000 for that. What you would do is, you're not selling them the property, you don't have an outright sale, you have damages on the property, so you would reduce your basis down by that $100,000 and you would have capital gain tax at, you know, 23.8% federal on the additional $20,000 beyond basis. You know, anticipated surface damages, they're paying you ahead of time of causing the damages, that's going to also be taxed as ordinary income, which is essentially rental income. They're paying you rent for doing that. Easements and right-of-way, similar treatment to the damages. If they receive a temporary easement on your property, a temporary right that's going to expire somewhere in the next reasonable period of time, 10 years, 20 years, anything of that nature, that is going to be ordinary income. They're essentially paying you rent on that property as well. Again, if it's perpetual, it's not going to expire, reduces basis just like the damage payments do. Any payments received in excess of basis would then qualify for capital gain treatment. All right, ways to minimize these taxes, minimize income tax. You know, like I said before on the net investment income tax, try to spread the income out over multiple years to lower your effective tax rate. You know, it wouldn't be very tax advantageous to receive two $300,000 leases in the same year. If you could receive one $300,000 lease in one year and then one $300,000 lease in the second year, you could lower your tax rate by using up the lower brackets over 2 years, if that makes sense. You know, the 39.6% bracket, which is the top federal tax bracket, starts at just under $400,000. So, you know, we don't want to pay the higher rate on all of this income when we could have it effectively taxed at a lower rate over multiple years. You can use installment sales for minerals or sales of other assets, real estate, buildings, whatever it may be. So that, and what that'll do is, like we talked about before, you'll have a receivable to you. You essentially sell or financing it. You recognize that income as it's collected. You can do a tax-free exchange or a like-kind exchange. So if you sell your minerals, you sell real estate, you can essentially, by doing a like-kind exchange, you can defer that tax tax by buying replacement property. For example, you sell your minerals, you can turn around and then buy land with those funds and defer the tax treatment. The basis carries over. Whatever your basis in the mineral is will become your basis in the land, plus any additional cash that you may have put down on the land. To completely avoid tax on like-kind exchange, you have to reinvest all of the proceeds. I've got a slide on that. We'll get to that in a minute. Just another thing to do to help minimize the income tax, just be conscious of capital gains versus ordinary income. There's a significant difference in the top rates on the two. The top rate for the capital gains is 23.8%. The top ordinary income tax rate is 39.6%, and you could also have the 3.8% Medicare tax on top of that. So it's a significant tax difference there. Even though it may be the same dollar amount of income, the actual taxes owed on those gains is significantly different. You can utilize retirement plans on other income like I talked about. And I've got a slide here on that, on what some of those are. You're in a 401k plan, you get a lease payment in 1 year, go ahead and max out your 401k, your SEP plan, whatever, to help push that off into other years. One thing to also be conscious of is just timely payment of your taxes. The penalties on that, we don't want to throw money away by just paying our taxes late. So, and we'll get to that in a minute as well. And also, you can bunch itemized deductions. If you're not somebody who normally itemizes for your taxes, you can stack your income tax deductions in 1 year. So you can essentially give 2 years of charitable contributions in 1 year. You could pay your 2 years of real estate taxes in 1 year, double them up into 1 year. So you'd end up taking the standard deduction in 1 year and then itemizing in the next year, if that makes sense. And you can alternate those years like that and help you be able to itemize more often. Another slide on like-kind exchanges. Like I said before, minerals are considered real property, can be swapped for any like property or any other real property. Land can be standing timber, qualifies as real property. So you're able to, if you were to sell your minerals and you did not need the cash, did not want the cash, you could defer that by buying replacement property in the form of other minerals, real estate, timber, or other like property. Just a slide on just the capital gains versus income tax, just to kind of show you the difference in the rates. Okay. Maximum federal long-term capital gain rate is 28.3%. And what this is tax on assets held for over 1 year. So at 1 year and 1 day, minerals, land, timber, and some other assets will qualify for this lower tax treatment. Ordinary income tax rate, the top federal rate is about 43.4%. That's the 39.6 plus the 3.8% net investment income. So let's say, for instance, you were going to sell a piece of property with a $100,000 gain at 365 days of ownership. You owned it exactly 1 year. You would end up paying about $43,000 of income tax on that gain. One more day would cut that tax down to just under $24,000. So significant savings there. Inherited assets. Many of y'all have inherited minerals. Those automatically qualify for capital gain treatment regardless of when the decedent purchased them or whenever they acquired them. Essentially what could happen is, the decedent could inherit the assets on the date of death and then turn around and will those to you in the same day. Say they inherited it and passed away the same day, it would still be long-term treatment for you on the very next day, if that makes sense. Mississippi has a maximum tax rate of 5%. Basically, Mississippi has just a straight 5% tax rate. I mean, the bottom two brackets are very small, and the tax savings on those are only about $150 per taxpayer, so it's very, very minimal. Louisiana has their top rate is 6%, and that starts at $100,000. So, but they allow a deduction for federal income taxes, which makes the effective rate somewhere around, it could be anywhere between 4 or 5% normally. All right, and I just want to touch a little bit on some retirement plans. This really has nothing directly to do with oil and gas, but when we start talking about deferring income, trying to minimize our taxes, we want to do everything we can, everything we have available, regardless of where the income is coming from. So if you're working a job, you have a 401k plan, you're self-employed, you have the option for a set plan, or just anyone has the option of doing a traditional Roth IRA. They want to take advantage of these to help defer that income out of some of these high income years and move them out into some future years. All right. One thing that's really important with this is timely payment of income taxes. Many of you are, and like myself, who are paid, you're an employee and paid a salary, you're used to having your taxes withheld from your paycheck, and that's how I am. Now, that's not the case with any royalty payments or lease bonuses. There's no income tax being withheld. The tax is not being remitted. You're getting a check which is the gross lease amount. No taxes withheld at all. You are responsible for having those taxes paid in. There's some requirements on what you have to pay in to avoid penalty. I recommend going ahead and trying to pay those taxes in if you can. Get your CPA to go ahead and try to calculate, give you a reasonable estimate of what the taxes will be, so then you can make a choice. Am I required to pay an estimate? And if I am required to pay an estimate, I'm going to go ahead and pay it. If I'm not required to go ahead and pay an estimate, I'm going to pay it with the return. At least I'll know what that number is. I'll know how much I'm going to need to have on hand when I file my tax return. Here are just the general rules on paying estimated income tax payments. If you expect to owe at least $1,000 of tax, and your withholding and other credits are not enough to cover your tax, you have to pay in the smaller of 90% of the current year or 100% of the prior year. So in this situation, you get a large lease bonus. What you would want to do in that case then is make sure you had 100% of your prior year tax paid in at minimum at that time. And that's going to prevent you from having any penalty. I would advise you to go ahead and have your CPA calculate how much tax you're going to owe and give you a real close guess on what you'll owe. That way you'll know you'll have it on hand. Some people may opt to go ahead and pay it into the IRS early. You definitely have that option. Or you could just stick it in, savings account or whatever, so that you'll have it when you file your tax return. There's also another method you can use other than just paying estimated taxes. You can use the annualized installment method. And what this method does is your actual income tax, you can calculate it on a quarterly basis and send in the actual amount of tax that you owe. This can be advantageous in a couple of different situations. One of them being your income declined from the prior year. So you may be required to pay in, based on estimated taxes, a higher amount in the prior year based on the 100% of the prior year. Well, my income went down. I know I'm not going to have to pay that much tax. How much am I going to owe? Make the calculation. You can use it on the annualized installment basis. All right. How can I remit taxes? Most common way, if you're paying quarterly estimates, Form 1040-ES. You can send it by check or money order with a voucher and mail it to the IRS. A new system came out a few years ago. It's called the Electronic Federal Tax Payment System. Corporations are required to remit their income taxes that way. And also any of you who are employers, you are required to remit your federal payroll tax deposits that way as well. You can also set that up for an individual. You can set it up for a year in advance. So you could go in there in April when you file your tax return. You know what your estimates are going to be for the whole year. You can put all 4 estimates in at one time. They'll draft out of the account on the due date. It's real simple, real easy to do. You can pay it with the return, which is Form 1040V. That may not always be the best way to do it. I encourage you to at least make sure you're going to avoid any penalties that may be charged. Another thing you can do, you can up your withholdings on retirement income, wages, anything like that. If you have enough other income, or you can adjust your withholding on those. You don't want to don't want to worry about sending in all these estimated payments. You can go ahead and make those adjustments and have it withheld from other income. Just a quick rundown on the federal underpayment penalty, and this will be the penalty for not making these payments and not having your taxes paid in timely. 3% of the average quarterly underpayment for 2013, and that's tied to the, I think it's the 30-year Treasury note, is that right? Yeah. There are some exceptions to making these payments. If you are a farmer, and at least 2/3 of your gross income comes from farming activities, you are not required to make estimated tax payments. You are allowed to pay your taxes once a year with the income tax return, or make 1 quarterly estimate. And this is regardless of maybe you got a big mineral lease in 1 year or not. It looks at either the current year or the prior year. So you may not be required to make estimates in these situations. You file before March 1st, you can just pay with the return, no penalties. Make sure also that if you're not going to file your return by April 15, get your CPA or somebody to run a quick estimate of what your income tax is going to be. You can make a payment with extension. That'll help prevent you any penalties for filing and paying late after that date. Mississippi underpayment penalty. Similar rules for the estimated payments. The interest rate, though, is much higher. It's 1% per month. Federal is only 3%. So if you were going to just pay one of Mississippi or the federal, definitely go ahead and send it to Mississippi as soon as you can. Same exemption applies for farmers and fishermen, and you also have the annualized method available as well. Benny's going to talk to y'all a little bit about gift taxes and state taxes.
All right, thank you. Thank you, Peyton. Does anybody have any questions about anything that we've talked about, or anything that y'all might have on any kind of income tax?
I do.
Income deductions, okay.
As we start getting checks, is there someone suggested keep 20% out to cover your taxes? Is that a safe thing, or 25% or 30% or?
Yeah, that's what I was getting into about making sure that you're paying your estimated taxes. You need to have a CPA, because there's no set rate for anyone. It's based, you have other income, other losses maybe that are carried forward, credits. It's a lot of factors that come into that. The main thing is to make sure you've got enough paid up to prevent penalty. You really need to consult your CPA about that. Okay, well then I'm sure that's good information. Yeah.
Good.
Yeah.
I'll just make one comment. There's not one plan that fits everybody. Everybody in here is a different situation. I in the last 31 years, I heard people come and say, well, my next door neighbor gets $5,000 back every year. If you come to me early enough, I can make sure you get $5,000 back too. But everybody's different. Everybody has different income, different deductions, married, single, dependents, no dependents, itemized, none. But I get that question a lot. And what I would tell you this, in general, 5% of the state of Mississippi, if you're in Mississippi, you're going to owe 5% of whatever you get. Now, the federal gets a little bit more complicated, because like Peyton's talking about capital gains, long-term, short-term, ordinary income, but you can get with your tax preparer, and they can calculate what we call as a blended tax rate. I mean, you could be in the 40% tax rate, but that doesn't mean you're paying 40% on all of your income. you're probably, if you're in the 40% tax bracket, you're probably paying a blended federal rate of about 26 to 27% tax. Meaning that you just take the total tax liability divided by your taxable income, you're going to wind up at 27%. So that's probably what you need to probably withhold back so you'll have the money. But just get with whoever you are handling your income taxes and see if they can just kind of give you a personal blended rate, or if you want to hold the maximum amount, you certainly can do that. You may not owe that much, but you can certainly do that. Yes, ma'am.
If I understand, okay, our CPA says 33% this year and 40% next year is what's going to be taken. And if I understand what you explained about the depletion method, and I've heard all day today to expect that the production will continue to come down, would we not best employ that depletion method?
Wait, are you talking about for royalty payments, or are these for lease payments, or both?
Royalty payments.
Okay. Yeah. Now, that is probably, considering straight 40% is probably going to be a little on the high side, but you are going to get a little deduction for depletion out of that. I think that rate may be a little high. I don't know your income tax situation, though. I mean, it's really on an individual by individual basis. Like Benny was saying, look at it on an average method over all of your income, what you need to have put back. I mean, 40% rate is the top rate, so it's probably not going to be quite that high. Now, if the production is declining, you do have the option to calculate it out on a quarterly basis, like I was saying, and use the annualized installment method. But of course, that does take a lot more work. You have to actually calculate the tax liability each month. Each quarter, rather.
Right. Now, the federal top tax bracket, 40%, married filing joint is $450,000 taxable income. That's after all deductions, personal deductions, standard deductions, all that. So you have to be in a fairly large income bracket to hit that. But if you're getting a lease bonus 1 year, and like I said, we practice a lot in South Mississippi and north, right below the state line, and we've seen some of our clients come in with extremely large lease bonuses, which I'm sure some of you have probably received. And you can be in the top bracket pretty quick. But for singles, it's $400,000. It's not much difference when you get to the top bracket. But I give people, I guess the most disgruntled client that I ever had. I've been practicing 31 years. You can't please everybody, but they always say, well, you always tell me the bad news on April 14th. And I always tell them, I say, well, I don't know what your situation is unless I see them a lot. Most of the time we see a lot of people once or twice a year at the most. In a smaller community, yeah, we see them at church and we see them a lot more. But, the best money you can spend is, once or twice a year, especially if your income's going up and down and you get something special. Call your tax professional and tell them, can I come by, can we talk, can I spend 15, 30 minutes? Let them know in advance what's happening in your life as far as your income, change of marital status, or whatever that is, and then maybe they can give you some planning ideas that you can implement before the end of the year. It's not a whole lot of ideas that Peyton and I can come up with after December 31st rolls around, besides some retirement contributions. So I just see over the years, you spend a little time. I know our time is your money. We understand that, but I think it's it'd be money well spent in the long run. Because especially if your income, you get a lot of big bonuses, big royalty, it's going to be worth it with the taxes that you're going to be paying.
Quick question on the percentage of depletion. Is that against your cost basis?
Percentage depletion is not against cost basis.
So
no.
what are you depleting? What's that?
It is just a straight allowance allowed by the tax code.
Against your proceeds?
Against proceeds, that's correct.
It's almost like a free deduction. It's not everything in the law, but 15% off the gross. And that's what he was telling. That's before severance tax. So whatever your gross runs are, gross royalty, you get 15% of that when you calculate percentage depletion.
Cost depletion would be against your cost basis.
So you're taking the 15% off your gross off the top, and then what is the severance of tax?
Severance tax is a state tax that is, and every state is different. Louisiana actually has several brackets based on production of the well. Mississippi is a straight 6%, but it's just an extraction tax. It's a state extraction tax that the operator pays, the owner of the well pays, and the mineral owner. Anybody receiving payments off of that well based on production will pay severance tax.
And is that a deductible item?
That is a deductible item, yes. And it's deductible after the 15% allowance. You get the 15% on gross.
Okay.
Would there be a combination of those people to pay the 6%?
It will. Everybody involved in the well pays the 6%. Yeah.
Severance tax already taken, but it was only at a rate of 1.34.
Okay, now, if you're talking about Virginia, we'll consider it Dade County recently.
Yeah.
Okay. The normal severance tax rate for the state of Mississippi is a flat 6%. These counties, just recently in this last legislation for the state of Mississippi, your legislators, both representatives and senators, were able to get that severance tax rate reduced for a short period of time after initial production to help the operators, help everybody kind of get the payout a little bit better. So what they've been able to do is the counties were able to forego their rate of severance, but the school districts were not allowed to give up their severance tax by statute. So there is a little bit, and just for the TMS right now, there is a little bit of rate on the TMS severance tax for, I think it's 2 years on that one.
That will ultimately return back to the full 6% rate. Yeah.
From everything that you said, so basically once you start receiving your royalty checks, that's when you need a CPA. If you don't already have a CPA, you have to make, you have to make the quarterly installments once you start receiving the royalties. Is that, you become self-employed at that point?
No, it's not essentially self-employment. You will be required or may be required to pay estimated taxes, and yeah, you definitely need to see a tax professional about that. I wouldn't advise it. I mean, yeah, it may calculate, based on just some standard amounts. You really need to go see somebody.
I mean, Peggy and I are both CPAs. We're going to advise you to see a CPA. There are many other qualified other tax professionals out there. We both CPAs since we both are. But I guess what we're talking about, I'm sure TurboTax will do it. I mean, I'm not really familiar with the program that much, but I know a lot of people use it. But I guess what you were asking is, you need to
start getting the checks. Is that when you start seeing the CPA?
If you want to, yes, that'd be wonderful. But I guess once you start getting the checks, just to make sure that you don't get penalized for not paying your taxes properly or quarterly, that's when you might want to consult somebody for a little bit of advice. But I'm not going to say that TurboTax couldn't give it to you, but on the phone, I'm just not familiar with it. But Peggy can give you the advice, I promise you.
But you don't have to pay them quarterly.
You don't have to pay, if you're not required to pay quarterly, you don't have to pay quarterly. But if you're required to pay quarterly and you don't, you get penalized. And if we don't, as preparers, don't calculate the penalty, you will get a notice from the IRS, and they will calculate it, so will the state. So normally, we always run that calculation on every return that we prepare.
Are you saying that if we get 3 checks or a quarter, and we don't pay the tax until the end of the year, we're going to face a penalty?
Not necessarily. And because there are some minimum requirements on what you have to pay in. You got to pay in 90% of the current year tax or 100% of the prior year tax. If you have that minimal amount paid in, you don't have to pay any more in. You can also use the annualized method, which is where you take those 3 run proceeds that you had and calculate out what your taxes along with your other income and deductions, and pay in that amount. It's not necessarily. I mean, if your prior year tax was 0, you're fine holding it over and paying it when you file the return.
You're already talking about trying to get around the penalty for not paying required
water amount. And here in the middle of this year, we start getting a check. And I'm current with a quarter then. Do I not have to pay in until after the year ends or whatever?
Okay, and like I covered earlier, there's two ways. You either required to pay them or not. And there's two ways to determine that. One is if you pay in 100, unless your income's real high from the prior year, which is over 150,000, you either have to pay in 100% of your tax liability from last year, or 10% if it's over 150,000, or 90% of the current year liability. And most of the time, unless you sit down and calculate, you're not going to know what the 90% of this year's tax is. So we advise people, if their income's going up, just to make sure that they have paid in 100 or 110% of last year's tax liability. Okay, and that will get you around the penalty. Now, if you start getting checks in July and you've covered the 100% or the 110% already, calculated in your quarterlies or whatnot, you don't have to pay anything more this year until you file your return.
I mean, my tax man set me up on a quarterly basis. Would I not be covered in that 100% or?
I'm more than likely, that's how he covered you. More than likely, before you got his new income this year, he set you up on 100%, more than likely. I wouldn't know that without looking at it, but that's what we did. We either, unless you tell us differently, we're going to set you up on 100 or 110% of last year's tax. System for a state and gift. And the only difference between the two taxes, same rate, same credits, same exemptions, and everything. The only difference is gift tax or gifts or while you're alive. The state tax is after you've passed away. That's the only difference between, they call them gift tax while you're alive and the state tax once you pass away. The rates are the same, exemptions the same. You know, it basically, a joint married couple can have lifetime, we're going to say exclusions, credits, whatever you want to call it, can have a lifetime estate of $5,340,000 this year. That amount, it goes up a little bit every year. It's based on inflation, but if you're married, you can basically double that. So if a couple has an estate of $10,680,000 or less, they can pass their entire estate to their heirs or whoever they want to, free of estate tax. Now, gift tax, like I said, is while you're alive. And the amount of a gift, everybody thinks of it as cash. You know, I'm going to write a check for $14,000 and give it to my kids. Well, the exclusion, which they call as an annual exclusion, is $14,000 per person per year. Now, it doesn't have to be cash. It can be, it's value, $14,000 of value. It can be real estate, it can be stocks and bonds, it can be jewelry, it can be whatever you want it to be. It doesn't necessarily have to be cash. If you give someone more than $14,000 a year, you're supposed to file a gift tax return for the amount that's in excess of the annual exclusion of $14,000. Married couples can give, like say me and my wife can give our daughter $28,000, 14 from me, 14 from my wife each year, and incur no gift tax. Now, gifts are not deductibles. Don't think that I'm getting a big lease bonus this year of $100,000. I got 5 children. I'm going to give them each $10,000, so I'm only going to owe income tax on $50,000. It doesn't work like that. Gifts are non-deductible by the donor and non-taxable to the donee. If there's ever any tax paid on a gift, it will be paid by the donor, never by the donee. Under some weird circumstances, but normally, so if you're the one making the gift, and you're giving it, if there's any tax liability to it, it's going to be on you, not the person receiving it. And I get a lot of questions about that. If people say, well, I'm going to get some money, I'm going to take a deduction on the tax return from the gifts. Gifts are not deductible, and they're not taxable to the recipient.
Let's just say you and your wife, say your daughter was married, could y'all give your daughter the $28,000 and the husband $28,000?
Correct. So we could give 28 to her, 28 to him each year. I mean, Peyton can give each one of y'all $14,000 a year to your spouses, to your children, as many times as we want. Just as long as we don't go over 14 to the one person.
Well, what if we do 15?
It can do 15, technically, the $1,000 that's in excess of that, you're supposed to, you need to file a gift tax return. Now, that doesn't necessarily mean you're gonna owe any gift tax, because there's an exclusion, and that's what I was gonna talk about next. You know, the exclusion is the same for gift tax and estate tax. When you make a gift in excess of $14,000 a year, you're gonna start using part of your exclusion while you're alive, of the $5,340,000 per person. So, and this just makes some easier numbers than that. So, say you make a $15,000 gift, so 1,000 of it is in excess. So if your credit, if your allowance was $5,340,000, now it's $5,339,000. You're not going to owe any tax, gift tax, until you exceed your annual exclusions plus your lifetime exemption of $5,340,000. You need to file a gift tax return. That doesn't necessarily mean you're going to owe any gift tax. The reason why they make you file a gift tax return is so they can keep up with how much of any prior taxable gifts that you've made in excess of the annual exclusions until you die. So let's just run it down. So I got a $5,300,000 exemption. Before I die, I made taxable gifts of $2 million. So when I pass away, and I now have not a $5.3 million exemption, I have a $3.3 million exemption because I've used two. So that's why I'm telling you, state tax exemption and the gift tax exemption, it's the same exemption. It's the same exemption. Now, if you make a gift of $10 million this year while you're alive, then you can use up all your $5.3 million allowance, and owe gift tax on the balance over that amount. And gift tax at that rate is 40%. And there's no state of Mississippi gift tax. There's no state of Mississippi inheritance tax. It's the same as in Louisiana, but the law's been changed in the last 10 years on both of those. So we're talking about just that. But I mean, we have, let's see, we're here.
What's the space bar? What's the space bar? Yeah.
Let's see. Let's see. I think I'm covering the last 3 or 4 slides all together, and it's kind of hard to work with slides because I just want you to, when you leave, to know that we're really talking about the same 5.34 million in allowance, whether if you're alive or if you pass away. And people get real confused about that because they think, okay, well, I'm going to go ahead and make a gift now, give away this out of my estate, and then don't realize that they've used up their allowance. When they die, they just wind up owing estate tax at the time of their death. And it's not a double. You don't get to use both of them. And I'm just going to say this: estate tax and gift tax, a lot of it goes based on valuations. And we do valuations at our office for all sorts of things, not necessarily real estate appraisals, but we value like closely held businesses, partnerships, LLCs, things like that. We do the actual equity side of the valuation to come up with any discounts or premiums or whatnot that need to be applied to gift tax. Because when you file a gift tax return or estate tax, you forget about anything that you paid for. It's all based on fair market value. And fair market value is what dictates whether or not you're going to owe the tax or not. And it gets complicated, it gets confused, and just something that if you think that you're getting close to $5 million or $10 million for a couple, then you probably need to get some professional help, at least review your financial statement and your balance sheet, your assets and liabilities. Now, there are a couple of things in the new law that helped out. One is it's a portability election. Before they passed this law a couple of years ago, if you were a high net worth individual, you really had to do a lot of hoops and jumps through to get around the estate tax. You had to create all kind of trusts sometimes, buy life insurance, make sure the assets are titled right in both spouses' names. You really had to do a lot of work, or you would lose part of your exemption. The new law is that even though one spouse dies and that spouse does not have enough assets to use up their allowance, the executor can make an election by filing his estate return for the decedent and elect to carry over the unused credit from the decedent to the surviving spouse. It's the only way to do that. You have to file a return to make that election. If you don't have anything,
at least you can get around from paying some state tax down the road by doing that. But I still suggest, even though that is the law, try to, in most cases, first marriages, second and third, things get complicated. In most cases, on first marriages, we try to get most people to balance out their estate, because you still come out better down the road by having a balanced estate between the spouses than you do electing the portability election. And the reason for that is that the surviving spouse could sell some of the assets that they inherit and skip some capital gain tax and skip some income tax. So there is a possibility to save some income tax after the first spouse died. Let's see what else. Is there any questions about the state of gift tax anybody has? I think we've got about 5 minutes left.
What's the benefit, you hear about portability, and you just kind of hit on that about having trust to try to get around the issue with high net worth individuals. But the purpose is to say other issues, probate, not having to go through that process, as well as protecting income, directing how to be utilized. Do you still suggest use of trust or LLC?
I'll hit the first one. There's a lot of attorneys who go around and try to sell living wills or revocable trust that when you die convert to irrevocable. And this is Benny's, not Silas Simmons, this is Benny's philosophy. I'm not a big fan of living wills. Living wills that you can change while you're alive, or trust. They don't do any estate or income or tax savings. They're there for, they have benefits for administration purposes. It's ease of transfer. You don't have to open and close accounts. You can change trustees. There's administration issues with that. So I'm not a big fan of the living wills and those sort of things. That's just my personal opinion. For tax purposes, it's not going to save any estate taxes because you got a revocable trust. Now, probate, in the old days, I would assume in the old days, the lawyers used to, charge a percentage or some things of the estates. I don't know any of them that we deal with that do that anymore. They pretty much by the hour. And, probate is not all that bad. On certain circumstances, it could be bad, but normally, probate's not all about. I think a lot of attorneys scare people about probate and how much it's going to cost to go through probate, where all you're going to do is you're going to create a living will or a trust, and it's just pay for all those expenses while you're alive. They're not going to do all these trusts and transfer documents and things like that for free, and that's what happens during probate. So you just got to kind of look and see which fits you best. Trusts are fine if you have some people that you're going to leave some assets to that are financially responsible. Trusts are fine, but they just don't. Just because you're doing a trust or doing an LLC or doing something like that, it's not going to automatically save any estate or income tax.
Can you tell us about the generation skipping tax?
Generation skipping tax, I didn't even mention that, but it's the same exemption. For the last 10 years, there was different exemptions for generation skipping, gift tax, and estate tax. Well, they're all the same now. So you hear the word, people talk about a unified credit, that's what they're talking about, because all three of those taxes are unified now. Generation skipping means that you want to leave $1 million to your grandchild. So you're skipping a generation as long as your child is still alive. Now, if you leave $1 million to your grandchild and his parents are deceased, and they basically stepped up into your child's shoes, and there is no generation skipping. But generation skipping is subject to the same tax as what we're talking about here, estate and gift tax. It's an additional tax. So you could wind up paying estate tax and generation skipping tax on the same dollar, which is never a good idea. Any other questions? If not, we appreciate y'all for letting us come. And if y'all have any questions, y'all have our contact information in your email, phone, fax, and thank you.